The UK's inflation rate will rise faster than any other country in the G7 next year. That's according to the Paris-based Organization for Economic Cooperation and Development. The news has some economists betting Mervyn King will be the first of the central bank governors to bump up interest rates, and it could come as early as next spring. George Buckley is with us live from London. He is the chief economist, UK economist for Deutsche Bank. Thank you so much for joining us, and welcome to Bloomberg News.
Hi.
How real is this risk that the UK could, in fact, clamp down too soon on inflation and perhaps maybe even stifle a recovery that's now in its nascent stages?
Well, I think it's a distinct possibility that the UK does move before any other country, and the reason being is because they've launched a very significant package for banks. We've seen more than 500 basis points of rate cuts. We've seen quantitative easing from the UK. There's been a big fiscal boost. Sterling has fallen. Commodity prices are lower than where they were a year ago. There's a lot of stimulus in the economy right now, and of course that could have a big impact in the future.
Let's talk about the economy going forward. When do you and Deutsche Bank believe that Bank of England will start to raise UK interest rates?
Well, I'm not as actually bearish on that as the market is. The market's expecting that they move sometime in the first half of next year. That's the consensus expectation amongst economists as well. My view is that they don't move until the third quarter of next year. But still, that is earlier than some people think they will move. I think they will need to think about the exit strategy at some point over the next few months. They won't need to actually do anything for some time yet because, of course, the economy, they really want to see some evidence that the economy is pulling properly out of recession. The last thing you want to do, as you said, is to stifle a recovery before it even begins.
George, any indication, any evidence so far that might suggest that quantitative easing is having some sort of inflationary impact in the UK?
Well, I think the really big problem with this is that inflation does take a long time to respond to monetary policy. The Bank of England expects that it takes around about 1 to 2 years before the maximum impact on inflation is felt from cutting interest rates, for example. Now, it may be the case that quantitative easing works through the system more quickly than interest rate cuts, especially at the levels that we were cutting from, because it's probably very unlikely that you see rate cuts between 1 and 0.5% having much influence very speedily. So it might take a while. So we haven't really had much evidence at all that quantitative easing is doing a big job, but it will do in the future, we think.
George, we have about 30 seconds left. Let's assume that the UK economy does emerge from this recession in the third quarter of this year. Going forward, what's the post-recession environment going to look like?
Well, I think that's the big issue. There's no doubt, I think, that we are coming out of recession, but I don't think it's going to look particularly good. I think we're going to see a lackluster recovery, and the Bank of England will be able to raise interest rates only very modestly and to not very high levels.
George Buckley, chief UK economist at Deutsche Bank, joining us from London. George, thanks.